Welcome back, everybody. Can you hear me?
Yes.
Wonderful. All right, so we've got a real treat in store for you tonight, and I hope that as you made your way through the reading, both Sandoe Investor and the Stonetrust Yellow Books, you started to get a sense of how Mr. Mohnish Pabrai approaches capital allocation and approaches value investing. And you'll see common themes with what we've talked about so far this semester. And you may see how he approaches it in slightly different ways than we have up to this point. So tonight, he's going to join us, as is Mr. Francis Chou, who was part of this Stonetrust acquisition. And we'll go through kind of an orientation for tonight in just a moment, but they'll walk us through from start to finish what they saw in Stonetrust, what they were looking at before the acquisition, how it took place, and then how it has done since then. Okay, so with that, I'm going to give you brief introductions to Mr. Pabrai and Mr. Chou. Both of them are preceded by their reputations. Mr. Pabrai was born in India and came to the US in 1983. He worked at Tel Labs from 86 to 91 in their high-speed data networking group, and then international marketing and sales. He started Transtech, an IT consulting and systems integration company, with $30,000 from his retirement savings and $70,000 in credit card debt. He sold it in 2000 for $20 million. He then started Pabrai Investment Funds, which he continues to run today. Mr. Chou, raised in India, began his career as a Bell telephone technician. He started investing with 6 colleagues and has a CAGR across his career of over 13%. With a high school diploma, he took the CFA exams and passed in 1985, earning his CFA designation. Barron's has called him one of the world's best investors, and there's actually a wonderful collection of articles about him on his website. And so I provided the link there because you'll have access to the slides after this class, and it would be worthwhile for all of you, if you haven't seen the articles yet, to go and explore those. So with that, I'm going to turn it over to Mr. Pabrai and Mr. Chou. Let me stop sharing the screen. And if you could take us through Stonetrust and what led you to it, why it was a meritorious idea at the time for acquisition, how the acquisition went, and how it's done subsequently, and then that we can go from there into Q&A. I'll turn it over to you.
Sure. Well, I'll get started first, if that's okay, Francis. So Professor Sandoe, thank you very much for having Francis and me join your class. When we had set this up many moons ago, it wasn't set up to happen with such an interesting backdrop. We thought it'd be a more sedate environment, but here we are. And it's kind of, I think it's kind of interesting and fun to do this with all the events and things taking place around us. We truly live in unprecedented times. I definitely hope I don't relive these times ever before I leave planet Earth. And probably that's likely, and probably likely for all of you as well. Anyway, so it's great to be here. And, you know, I accidentally heard about Warren Buffett, you know, I think reading a book by Peter Lynch. This was maybe 26 years ago. And I'm an engineer by training, and I was just very intrigued once I heard about Warren Buffett and his approach to investing. And that eventually led me to abandon tech and engineering and move into investing and compounding and so on. And it's been a really fun quarter century over you know, trying to practice that. And I cloned many aspects of what Buffett did. I like to say that I'm the shameless cloner, and cloning is one of the best mental models you can adapt. It's very powerful. A lot of people have figured out a lot of smart stuff, and you can just lift and take that. You don't need to invent everything yourself. So cloning is definitely good for your financial health and probably for your well-being in many other ways. Um, and I had always been intrigued with the Berkshire Hathaway model, and always been intrigued with Buffett's use of float, and so on. And so in the 2014 timeframe, I got to know that there was a insurance company, privately held insurance company in Baton Rouge, Louisiana, which focused on workers' comp, that possibly might be available for sale. And I thought, well, it would be interesting to actually have a vehicle, an insurance vehicle, with float, etc., and to try to clone that aspect of what Warren Buffett did. And so I set up another entity called Dhando Holdings, separate from Pabrai funds. I raised about 150 million from a number of investors, and the idea was to acquire Stonetrust, and also to maybe possibly acquire other private businesses. Uh, the 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 funds I run, Pabrai investment funds, are focused on public equity markets. They're not set up to do these kind of private acquisitions and so on. So I was setting up a second vehicle, which basically would give me the wherewithal to, in effect, be able to invest in a broader range of assets. And so we raised the money, and we bought Stonetrust for 65 million. And I think before the ink was dry, I was beginning to understand that maybe I made a mistake. And one of the things about investing is that you really understand a business only after you own it. So if you run some paper portfolio and buy and sell stocks on a spreadsheet without real money involved, the learning is not really going to sink in as well as when you make real investments with real money and you end up losing some of it. That's really when the learning kicks in. So there's really no way to avoid that tuition bill in terms of learning. So once I was realizing that maybe it wasn't the brightest idea I ever came up with to buy an insurance company, I was then confronted with either, live with the decision or be honest with myself and be honest with my investors and try to reverse the decision. So we will all make mistakes. Mistakes are par for the course, but we also need to consider what we do once we know those mistakes have been made. And so I realized that Stonetrust had many aspects to the business that were really good, but I also realized it had some aspects of the business that were not so good. And I came to the conclusion that I did not want to be owning and running from a board level that insurance company, because the opportunity cost of what else I could do and what else my investors could do with those assets, I considered pretty high. So, if you have studied John Shackleton, when he embarked on getting to the South Pole, that was his primary objective for that mission, get to the South Pole. But once his ship got trapped in ice and it started breaking apart, and he knew there was no way in hell he was going to get to the South Pole, he changed his mission, and his mission was now to get his men back to safety. And so once I realized that Stonetrust was a mistake, not where I wanted to be, my primary objective was to get my investors' capital back to them, and ideally get them back 100 cents on the dollar. So even if they didn't make a return, if you have a mistake in investing and you get back all your money, that's a pretty good place to be. So the insurance business, and of course Francis is on the other side. He's an owner of the business. I know he loves Stonetrust, and I know they're doing extremely well actually under his leadership, which is wonderful. The insurance business has a number of great attributes. One of the biggest attributes is that it is a business where your customers give you money today, and they may never ever come back to take that money from you. They may never have a claim, and such is life. And you get to get the time value of that money over time. The second is that there is a recurrence to that revenue. So if I'm a business, if I'm running a barber shop, I need to have business insurance. I need to have workers' comp insurance. I need to have a variety of different insurance coverages required by law. Workers' comp, for example, is required by law in all states. And so it's a mandatory requirement like auto insurance. And generally speaking, if you've written a policy for that barbershop, the odds are pretty high that when the time comes to renew, a good portion of the business will be sticky. It'll come back year after year. So the recurring revenue is one of the most beautiful aspects of any business you can own. Getting into businesses where you don't have recurring revenue can be quite uphill. There are a variety of business models that work well, but in general, recurring revenue is really good. So insurance has some really good aspects. It has a recurrence to it. It has other people giving you money today. Now, if I just compare that to lending, in my opinion, lending is one of the worst business to be in, because when you make a sale, the money leaves your kitty and you hope and pray it comes back. And in the time of Corona, who knows how much is coming back? So I think lending is the opposite of insurance, in the sense that when you make a sale, it's terrible that you make a sale and money leaves the door. At least in insurance, you make a sale, money comes in, but you have to make sure the policy, the price correctly. Many times, one of the things I learned after buying insurance or buying Stonetrust was, one of the things I really did not like about the business was, you make a sale, but you don't know your cost of goods for that sale many times for several years in the future. So I've sold an item where I don't know what my cost of goods really is. I may have models that will help me estimate it, but those models may or may not work. It just depends on the way things unfold and such. And Francis can probably tell you about the nature of their claims that they're seeing today in the business in the time of Corona versus what they were seeing maybe 6 months ago. It's changed quite a bit. So once I decided to sell the business, the Stonetrust was doing reasonably well. It was a business in pretty good shape, which is, I said, okay, maybe this is a good time to sell it. And I decided let's try to unwind the transaction. And if we can get around 65 million, which we paid for it, maybe even a little bit less or a little bit more, that's fine. We'll go ahead. And so we hired bankers and we started the sale process. And then I think maybe Francis can correct me if my recollection is wrong, but he called me after we had started the process, and he was almost offended. He said, Mohnish, I heard you're selling your insurance company and you did not call me to offer it to me. And I said, I didn't call you to offer it to you because you're a friend of mine. I'm selling a business that I'm not very happy with. I really like Francis a lot. I value our friendship a lot. I don't want to do a transaction where I'm trying to exit with someone like you because you're too near and dear to me. He said, no, I would love to buy the business. So I tried really hard to convince Francis not to buy the business. And I tried really hard, just like I'm telling you, all the negatives of the business. And it fell on deaf ears. And I told Francis, please, please don't buy the business. And Francis would say to me, Mohnish, please, please only sell the business to me. And so here we are. And now I think it's been, I think more than a couple of years since we closed the deal. It was very important to me, no matter who the buyer was, that anytime I'm doing any kind of transaction or deal with anyone, they should get a good result. Not just I should get a good result. I always think that one has to think about the greater good and not just think about transaction. Hey, I did well and that sucker got left holding the bag. That's a very bad way to live your life. And if you lived your life that way, life is not going to turn out so well for you. So it's always been very important to me that whoever is the people in my orbit, my investors or my vendors, or when I'm a customer to somebody else, etc., all of those relationships be win-win relationships as far as possible. And Francis had been a very close friend. He's a very high quality human being. And I did not want our friendship or our relationship being negatively affected, which is why I tried really hard not to sell the business to him. But he insisted, and here we are. And so with that, maybe Francis, I'll pass the floor to you, and let's hear your perspective on this.
Thank you, Pabrai. No, I heard about Mohnish was selling the business on one of the chat boards. So I phoned Mohnish and asked him whether it's for sale. And I was surprised how quickly we came to the price. We had some, a bit of a concern about reserves and so on and so forth. But Mohnish was really quick in proposing the term, and I think I accepted it within 48 hours. So it was really quick. And Mohnish told me, was giving me like how to buy a business, how you should buy a business. And he said, first thing is, should really consider is the person selling the business to you. And he said, it's me selling to you, and therefore you should do no due diligence. So you should trust the person. And so if you know the story, I hardly did any due diligence based on what Mohnish was telling me. And that is how it happened. So there were a few things that are important is when you buy an insurance company.
In fact, if I can just interrupt Francis for a second, it was 4 months after he bought the business that he showed up to see it for the first time. And it was kind of nice, he said, he felt that to see that it actually existed.
But what Mohnish is saying is quite true. I did not even visit the office. And I had a chance to meet the executives, not in Baton Rouge where it was based, but in New York by accident. So we had a nice dinner, and I had a chance to talk to executives, like the president and the CFO and the actuary. And then I kind of had a good understanding that a lot of things that Mohnish had done previously was something that I would have done, and therefore I don't have to do it. So let's look at a few things that Mohnish said. First, he moved to Nebraska, where it should be where we report to the Nebraska commissioner instead of Louisiana. Now, Nebraska is really important because of what we call it the investment rules. So it's much more lax. Some states have investment rules where you can only put 5% of your capital into equities, whereas Nebraska had far more liberal rules. So you can put almost close to 1-to-1, and that is important in an insurance company, because if you cannot invest in equities, insurance as a rule are just lousy businesses, and you don't make an adequate return. And so when I was looking at the business, so reserves comes first thing in mind. You can really play with reserves, and so how do you evaluate reserves? So I was fortunate enough that I've been I've been involved with Fairfax since 1985. So I've been in the insurance sphere for a long time. And the first thing I looked at was, like, when you look at workers' comp, one of the biggest danger in workers' comp is how many claims you have. Now, if more than 90% of the claims are not resolved within 2 years, it can really spiral, and that is the biggest danger in workers' comp. Like, if you don't settle it in 2 years, what happens is that 2 years can become 10 years. You're still paying the claims over 10 years. So in Stonetrust's case, 90% of their claims were resolved in 2 years. I think it was around 91%. So that gave me a great comfort factor. A second one was the number of claims count. It was less than 300. And I thought if it goes over 500, it would be, they were not doing their job. So 300 meant they were really doing a fabulous job in looking after claims. And second one was, as you know, claims are extremely dangerous. When you go into insurance, you don't know your cost, as Mohnish has said it earlier. And sometimes, you're pricing something that you don't know, like 20 years later, what the price should be. But in Stonetrust case, the duration of an average reserve was only 3 years. So if I am off in my pricing, I'm only off by 3 years. So these were factors that came into it in terms of understanding whether I should do, a total due diligence. So they all came in really, like, they were lined up. And knowing Mohnish, I knew it was a really well-run company. So the next part that becomes really difficult is, how do you make a deal? And as you know, when you make a deal, it can become really acrimonious. But in our case, Mohnish and I, we struck a deal in less than 48 hours after I saw the numbers. And there were a few things I was a little bit concerned about. And Mohnish said, why don't we do it like this? And I agreed right away. And so over the 6-month period before closing the deal, there were minor issues here and there. And we hardly ever went to any type of long negotiation. We just picked up the phone and we just resolved it over the phone. We didn't have lawyers battling each other, his lawyers and my lawyers battling. We just talked on the phone and we just resolved it ourselves. So that's how it went from my side. And in the end, it turned out really well. So I go into Stonetrust 4 months later, and I thought I'll be seeing a lot of cockroaches, a lot of stuff Mohnish did not tell me. No, it could be hiding in one cupboard, maybe in several cupboards. But I went there, it was truly, really clean. Everything that Mohnish told me, was true. So you can see, like Mohnish said, in businesses, knowing the person is important. Knowing that guy is honorable is important. And that saved us, I think, most likely in a small deal like Stonetrust, about $70 million. That must be $2 to $5 million in legal fees and professional fees.
Yeah, and one of the things that I've always felt, which is a very good saying to keep in mind, is you cannot write a good contract with a bad person. So you can never expect a contract to protect you if the ethics of the person who's signing the contract, your counterparty, is in question. So the most important thing you got to figure out, and I think this is the most important thing in life in general, is all the people in your orbit, all the people you do business with, the people you work with, they all need to be high quality individuals. It is not worth it to try to go through life without that basic edict. And when we closed the Stonetrust transaction, on closing, Sandoe received $45 million, and we had notes receivable from Francis for $26 million. And I would have been unwilling to have even a small fraction of that receivable with anyone if it wasn't Francis. Because a lot of that receivable was subject to adjustment based on what happened with reserves. And so we gave Francis a warranty And I knew that, so what we said is, okay, look, if the reserves actually prove to be inadequate, then you can take some portion or all of 16 million out of the 26 million and adjust the purchase price in the future. And if we offer that to any buyer in insurance, they can fudge the future reserve numbers and say, hey, we are 3 million short, or we're 5 million short, or whatever. And then the mechanisms to try to resolve that aren't the easiest. So because I had complete trust in Francis, in fact, what happened is we were supposed to every year each pay an actuary to do an analysis on the reserves and then take a middle of those two. So my actuary was his. Every year we have both waived the actuary coming in to do that, which means we both save 100,000 or something in cost, because we've, like he said, he found it's a clean company and there were no misrepresentations I made to him. And on the flip side, they've been Francis has been an extremely honorable buyer, where we've gone, I think more than 2 years now, there's been no purchase price adjustments. The purchase price is where it's been, because the reserves have proven to be accurate and such. So I think these lessons are not really related to insurance. They're not even related to M&A transactions. I think the lessons relate to how you should live your life, in terms of, who you go for work, who to go to work for, who your business partners are, just every facet of your life. You want the highest quality human beings all around you. And once you have that, everything else goes really simply after that.
So with regard to the reserve adjustments, we had 2 years. One was last year, and then one was this year. And I would phone Mohnish sometime in September and October and said, forget getting your actuary, to do a reserve analysis. So it's been 2 years now. There's 2 more years to go. But you can see, the company is clean, and there's no doesn't make sense playing with numbers.
So maybe what we'll do is we'll open up to questions. If you want to ask questions on Stonetrust, that's perfectly fine. If you want to ask on other subjects, that's also fine. Anything other than what we're buying right now, I think is fair game. So please feel free.
You had a question, didn't you?
Yes. Can you hear me?
Yep.
Absolutely, yeah.
Awesome. Well, thank you, Mr. Pabrai and Mr. Chou, for taking the time to come talk to us. I have a couple of questions. The first one would be about insurance, and the second one would be about your foundation. So I guess I'll start with the insurance one. How do you value an insurance company? Is it based on the amount of reserve? Is it based on the amount of reserve they have, or you value it based on their have?
Okay, I can go. You always start with not the book value, but the adequacy of reserve. Once you establish that the adequacy of reserve is fine, then you go to book value, and so that's where you start. And if they are higher rated companies, then you pay a premium to book. But for most companies, yes, it's somewhere around book plus 20% or book plus 10%. And then during good times, it can go to like book plus 30%. But that is where you are most of the time.
And my second question is about Mr. Chou's fund. You've had a lot of good years and a couple of down years. How do your clients take that? Do they stay with you through the good and the bad, or?
It depends on your investors. So as you know, I have not marketed my funds, and I just have one employee with me, and so most of them have come in through word of mouth and by knowing about how I invest. And so what I don't have is something called hot money. and we have not done well the last 4 or 5 years, and some of them could be because value has not done well. And the other side is also, we were some of the stocks we picked were not were not the greatest. We made a few mistakes, a few assumptions that are wrong. We did not we did not like we did not properly estimate how low the let's say the price of oil and gas would be and how long they would be at such a low price. The same thing with commodity businesses. And we also made a lot of mistakes on the other side. Good companies that we thought were overvalued, but when you look back on it now, let's say after 10 years, most probably they were undervalued because we did not accurately calculate how fast they were growing. Part of intrinsic value is the growth of the company, and we all, as value investors, we tend to underestimate that. So value investing is, you make mistakes, and best thing is face up to it and acknowledge it. Because if you don't face up to it and acknowledge it, you will keep repeating it.
I have a question regarding like the trust. It's amazing how you were able to do big transactions with such good friendship and stuff. But what if it's not really available like for us or these days? It could be hard to trust another investor or another potential partner. And again, how do you trust the employees as well? I would love to hear your feedback on that.
Maybe I'll go first. Maybe Francis can chime in. I think that's a really, really good question. When I had lunch with Warren Buffett, 2008, it was a slightly expensive lunch, but now in hindsight, it looks pretty cheap. But anyway, one of the questions, actually, I made a comment to him. I said, Warren, how come you are such a good judge of human nature? How are you able to figure out people so well? And so he said, actually, Mohnish, I'm not good at judging people. He said, if you put me in a cocktail party, 100 people in a room, and I got a chance to spend a few minutes with each person, he said, I could probably tell you that 4 people are exceptionally good. And I could probably tell you that 4 people are exceptionally bad. And the other 92, I would not be able to make any judgment on. So he says that the way he lives his life is by being a harsh grader. And so what he means by that, he said that I only let in the 4 people into my life who are exceptionally good. And I don't give benefit of doubt to the 92 who we don't know whether they're good or not. And we definitely have no interest in the ones who are, the bottom 4%, if you will. So the thing is that as we go through life and as we encounter people, there will be data points that will make it clear relatively quickly in some cases that some individuals are exceptional. And there will also be some data points which tell us that some individuals are just not worth bothering with. It might be the way they treat the server at a restaurant, or their perspective on different things in life. There could be subtle clues of that. And so the key is that, which I've taken to heart from Buffett, is be a harsh grader. So when you pick up some signals, even though they may be relatively weak, about some people, Charlie Munger says, there are enough nice people in this world that you don't really need to, make exceptions or accommodation. So it is not natural in human nature to be a harsh grader with various humans. That's a very almost inhumane thing to say. But it is extremely good to have an exceptional life. Because one of the things about humans is that there's a gravitational effect. If we hang out with people who are better than us, we're going to get better. And if we hang out with people who are worse than us, we're going to get worse. So our quest should always be to hang out with people that we like, admire, and trust, and to minimize or get rid of the relationships where we have question marks. And one of the I would say things that Buffett says to students, he says, let's say you're in a class with 40 other students, and you know these 40 people quite well. And he says, let's say you could offer a deal to any student in the class where you would give that person half of your lifetime income. And in return, you would get half of their lifetime income, a swap. The question he asks is, who would you do that deal with, right? And the answer that's going to come out usually is it's not going to be the brightest person. And it may not even be the hardest working person. But it's going to be a combination of integrity, intelligence, and energy. Someone who's got very high ethics, someone who's pretty smart and works hard, that kind of combination. So generally speaking, when you try to identify those types of traits, so it's not that hard to be able to figure out the lazy ones and take them out. It's also not that hard to start figuring out people who are cutting corners in different ways, take them out. So just be a harsh grader, look at the way things are, and you can start getting better over time. And the advantage, I can just tell you that, when I look at the friends I have, and I look at the people I spend time with, it's a very blessed life. Because I've deliberately been doing for decades culling. It's harsh, but culling is very important so that you have the time for the highest quality humans in your life.
Yeah, I know when I was really young, coming out of Bell Canada as a technician, and I was looking to get into the investment field, I was just looking for a person I could work with for a long time. I was fortunate enough, that in 1984, 1985, I met Prem Watsa. As you know, Prem Watsa is famous for having guided Fairfax Financial to what it is today. And so it's important to go with good people, good integrity, and long term, but it will make a big difference.
If I could just thank you for having a momentary lapse and spending some time with the 92% you're not sure about. We certainly appreciate it this evening. But I wanted to ask how you go about defining your circle of competence. And when we have this is such a unique environment for me as an investor where markets moved so quickly that the speed of the reaction and the opportunity that presented itself was really on a scale I hadn't seen before, and I think it's really important to understand what your circle of competence is, but also when these opportunities are presented in front of you, how you go about evaluating. Well, maybe this is an opportunity, or it's close enough to this area that maybe it's an adjacency I could venture into. So how do you deal with setting hard boundaries, and then when do you relax them?
Well, maybe Francis, I'll go first, and then maybe you can share your thoughts after that. So first of all, we don't have the 92%; we have the 100% in the class. There's always the quest for the 4%. So it's not an entirely lost cause to hang out with you guys. There are a few diamonds in the mix, and I hope we have the smarts to figure that out. So I think circle of competence, Charlie Munger says, to ask the question is to answer it. So if you have to ask yourself if a particular company is in your circle of competence, you have already answered it, and the answer is it is not in your circle of competence. So it's a pretty simple test. The second thing I think which is useful in this environment just to keep in keep in mind is, I think when Bill Gates and Warren Buffett were asked the single most important trait that has been most important to their success in life, they both say it's focus. And so the thing is that as I look at what's happening with us, obviously the human tragedy is terrible, and of course we have all our lives disrupted. But when we look at the markets, quite frankly, we were at relatively elevated levels before all of this, and it's I don't find that many things that are obviously cheap based on what's happened in the last few weeks. So I have found one business so far that I am quite excited about and I've been buying. And there possibly may be another one. But when I look back at 2008, 09, at that point, it was an avalanche of incredible deals. I mean, literally you could throw darts, and it was so hard to keep up with the amount of stuff coming at me. So I was doing basket bets because there were so many companies that looked so good. So I said, okay, instead of making a 10% bet, I'm going to make 2% bets on all of them because they all look so cheap and I don't know which one does the best. And all of them went up 5-6 times or 10 times, whatever. So in fact, at that time in 08, 09, I don't think there was any business I invested in which was not a winner. So we are nowhere near those levels today. And I hope we don't get to those levels because that would mean that, there's a lot of other things going on which are quite ugly. So I think in this environment also, even though we were not medically ready for COVID, the fiscal and monetary response, especially in the United States, has been remarkably fast and remarkably furious. I think part of it because of the lessons that these guys learned in the financial crisis. And so I think that end of it is actually working better. This is a much more deeper dive than we went through. We already passed 10% unemployment. It took us, 15 months to get to 10% unemployment in 08, 09. So yeah, I think the circle of competence is very fundamental. It should be obvious to you that you understand how the business works. And many businesses are relatively straightforward to figure out. If you look at MasterCard, it's not that hard to figure out that business. American Express, not that hard to figure out. Carnival Cruise Lines, not that hard to figure out. So, but there could be many businesses which are pretty hard to figure out. So you have to take a pass very quickly on the ones where you're scratching your head and hone in on the ones that you think you can get your arms around. Francis?
Yeah. So when you're looking at like in the market, you should there's 30,000 stocks, or maybe more, and you only need like 10 or 15 of them. So if you miss something, you can always go to the next one. So if you look at my career going back like almost 40 years ago, I was just coming from Bell Canada as a technician. And so I concentrated on something called financial bargain. I was much closer to what Benjamin Graham was doing, like buying net nets and so on. And when you buy net nets, they are really cheap on an asset side. But in 1981, 1982, you had another big benefit. Not only these companies that were net nets, but they were also good companies. And so you had the best of both worlds. So that is what I was doing when I started my career. So as my knowledge grew, then I went into higher quality companies and was willing to pay up. But you can see even in Stonetrust, I did not veer off my line. I went into something that I was quite familiar with. I had dealt with workers' comp when I was at Fairfax in 2001 and 2002. And so I knew what I was getting into. So the key thing is know what you're getting into and into the fields that you're in. So just don't go adjacent to it. Like even if you play racket sport, and if you're really good in racket sport, and if you're really good in tennis, stick to tennis, but don't go to squash or badminton. So that is what I mean, sticking to a circle of competence. And so that is what I do. Lately, let's say because of the COVID crisis, like I don't have confidence in terms of understanding how the stock will work out. But a lot of the bonds have been beaten up, like by 50%. Like a bond that is worth 100 cents on a dollar, a lot of them you can buy them at 50 cents on a dollar. And that is way, way cheaper, way more safer than buying equities. So you can see that you have options and you can look at it. Another way is to buy fixed income instruments, which is an easier way to play and safer way to play. And you're getting almost the same kind of returns as stocks.
Question, and again, thank you guys for being here. Mr. Pabrai, I know that you had the ability to have lunch with Warren Buffett. So any other key insights into that would be great. But I guess thinking to your acquisition of Stonetrust, does Warren Buffett's history in insurance, do you think that swayed you to think that that would be a great route for you to do in your investments? And were you thinking about buying any furniture marts in Nebraska?
Yeah, well, thank you for the question. Well, I mean, I think on the insurance side, yeah, I was swayed by Buffett, but one of the things that I think most people don't understand about Berkshire Hathaway, and even I didn't understand this until recently, is at the highest level, when you look at a property casualty insurance company, what the regulators and rating agencies want you to do is they, generally speaking, want you to take the money that has been set aside to pay future claims, the reserves, and invest that in a very low risk manner. And they, like, if you're going to do it in bonds, they ideally want those bonds with maturities which are matching your liabilities. And then your surplus or book value, generally speaking, that with some restrictions, they allow you to go into equities. All the different states and countries have different regulations. Like Francis mentioned, Nebraska is more favorable. No surprise because Buffett is there and probably part of his influence. But the one advantage Berkshire Hathaway has, which almost no other insurance company has, is Berkshire has almost no restriction that their float needs to be in fixed income. Because of their AAA rating and they're such heavily overcapitalized insurance companies, they put a railroad inside the insurance companies. And those regulators love that railroad being inside that insurance company. And they treat that railroad like it's a bond instrument. Okay, but it's got, the railroad, just to give you an example, Buffett spent 30 billion on that railroad. It's worth over 100 billion now. And the regulators are treating that like a bond. No bond has done that since he bought the railroad. In fact, with Corona, actually, if you held bonds, you would have actually had not such a great ride on many of them. But of course, I think from now on that ride is pretty good. So I think that I came to the conclusion that insurance is a business that's good from far, but far from good. And I think Francis and his team, I think at Stonetrust they will do okay because it's an exceptional team. There's an exceptional investment manager on that team, and there's an exceptional set of executives on the underwriting side. So it does take some incredible prowess to make that engine work. Whereas if you owned a Coke bottler, your idiot nephew could run it and it would make money. You cannot have your idiot nephew run Stonetrust. It would get into trouble in no time. When we had lunch with Warren Buffett, that lunch went for like more than 3 hours. In fact, I think one of the first things Buffett said is that I got nothing going on all afternoon. When you get sick and tired of me, you let me know and I'll leave. So I'm here till you kick me out. And and he actually stuck to that. He actually just was totally laid back. And I think between us, we probably had more than 50 questions for him. And many of the questions by themselves were worth the price of the lunch and then some. But for example, I asked him a question about Rick Goren, who was one of the three musketeers with Warren and Charlie in the 60s. And I hadn't heard of Rick Goren in a long time. So I said, are you in touch with Rick? Because he kind of fell off the face of the earth. And of course, now Rick is a good friend of mine. I've reconnected with him. But at that time, at the time of the lunch, which was about 12 years ago, I didn't know that. So Warren said, yeah, I'm very much in touch with him. In fact, he plays bridge with Rick regularly. And when the 73, 74 crisis hit, that was a very intense drop in stock prices. Rick was levered and he got margin calls, and he ended up selling a large portion of his Berkshire Hathaway shares to Warren Buffett at $40 a share. The things that were recently priced at $300,000 were sold at that time for 40. And of course, Rick has done very well since then. He's not suffering. But Warren said that, if you're even a slightly above average investor, over a lifetime, if you spend less than you earn, you cannot help but get rich. So all of you in Professor Sandoe's class, with your past education and the degree you're getting now, you are definitely significantly above average in annual income versus the rest of the population. If not now, definitely in the near future. And you can just run the math yourself. If you're maxing your 401k, maxing your IRA, and spending less than you earn, even if you have a single digit return on that money, maybe 5 to 10%, over time, that's going to build up, and especially with employer matches and everything. So Einstein used to say compounding is the eighth wonder of the world. And there are three variables. You need to get fluency in compounding. And, we're not going to go there too much in this class, but there are three variables that control compounding. Your starting capital, or the capital you're contributing every year, the length of the runway, and your average annualized rate of return. And so if you think of those three variables, I have some videos you can look at. I think I gave a talk one time, University of Puerto Rico, which goes into it. I'd recommend you maybe hear that talk. But basically the bottom line is that if the runway is really long, even with very small amounts of capital and even with not such a high rate of return, you will end up with spectacular sums. Or if your runway is short, you need a higher return to end up with the same result. So they're interchangeable. So if you look at someone like Warren Buffett, so far his runway is 70 years old. He started at the age of 20 with 10,000, and now he's 90, and he's been compounding for 70 years. And he's continuing to go, and look at the opportunity Mr. Market has served up to him now. And so the most important thing for all of you is start early. One of the problems is I asked Professor Sandoe before we did this is, what's the average age of the students? And I was so disappointed when he said you guys are in your 30s, because I wish I was talking to you when you were 17. And actually even 17 is a little late, because if you had part-time jobs when we were 14, the IRA laws allow you to open an IRA even when you're 3 years old. There's no minimum age to open an IRA. And you can put 100% of your earnings in the IRA as long as it's less than 5,000 or 6,000. So those early starts are extremely important, but all is not lost. Even though you're in your 30s, all is not lost, because you will live a lot longer than Francis and me. So your runway end date will be a lot further out than our runway end date. So you still have probably, I would guess, maybe 6 decades or something of compounding ahead of you, and get on with the task.
Support what Mohnish is saying about starting as early as possible. It's not just a runway, but as you know, we are human beings, and the earlier you start, what you will have is that you're going to make mistakes. And when you make mistakes when you're young, it's much easier to bounce back and say, okay, what I'm thinking, I think I was thinking this way, and I thought I would make a lot of money, but it proved I was wrong. Therefore, you can start early. So if you start at 25, versus 50. At 50, if you make that same mistake, you would consider yourself an utter idiot. But at 20, 25, no, you just start again. So you have that benefit when you're younger. So you can make mistakes and you can bounce back. So I was fortunate. I started investing at a really young age, and I've made a lot of mistakes, and I was able to bounce back without really hurting myself. So you have to give allowance something for mistakes. Even we as portfolio managers, we are only right most probably only 60% of the time. 40% of the time we are just either making mistakes or they're not right decisions. So those are the batting ratio to give you a rough idea.
Do you want to go ahead and ask?
Yes, Mr. Pabrai and Mr. Chou, thanks for joining us. I'm interested in hearing when you first started your career. Both of you have pretty incredible stories, and you took a different path than most people who will continue to work for a company. I'd like to hear, what was it that gave you the initiative to do that? Or to say it another way, if you have a son or a daughter, what type of advice are you giving them?
Maybe I'll go first. So I think one of the negatives you run into when you have these advanced degrees from elite institutions is that the opportunity cost for you to do something else is really high. So what I mean by that is that if you are an MBA from Harvard, the marketplace recognizes that and is willing to pay good sums for that. And so if you were to say, okay, I'll ignore that and I'll go on my own, what you're giving up in terms of lost income for a flyer is quite high, right? Because the opportunity cost is so high. And so generally speaking, we don't end up with a lot of Harvard MBAs doing non-venture backed startups because it's the risk factors for them and the risk reward doesn't appear palatable. But there's a way around it. And so what I've always told young people and my kids is that, and it's the same with my experience, is when I was leaving my first job to start my first business, what I did was I actually ran my business while working for 9 months, because let somebody else pay the rent, let somebody else pay for the groceries, don't start any burn, because my employer needs 40 hours a week. And I used to put in a lot more hours, but once I started my own business, I went down to exactly 40 hours. I was no longer concerned with great reviews. I was only concerned about slightly above firing level. So, like the New York governor wants to keep the shutdown, so he's just slightly under the number of ventilators and ICU beds. He just doesn't want to blow past that number. And every day he gives us all the data on how he's just under that thing. My take was just do enough so you don't get fired, okay? And focus all the energies on the business. And so I was trying to get my business part-time off the ground, and I used to go to work, and evenings, weekends, I would work on the business. And after 9 months of doing that, I had a few clients, I had revenue and cash flows, and I was dying to go full-time because I was, putting in probably 100 hours a week. And I went in to resign to my boss and his boss. And they both talked to me. They said, now it all makes sense because I told them I had started this company. It was not competitive with what they were doing. So they were very supportive. But they said, we had many discussions over the year that your performance had dropped off, but it hadn't dropped off so much that we wanted to fire you. But we were just concerned it had dropped off. I said, exactly. That was my point, is to make sure you never get to a point where you're terminating me, because then the plan doesn't work, And so when I was leaving, my employer told me, you can come back anytime. You'll get a raise. You'll get a higher position. So I thought, wow, there's no risk, because one is I've got a business that's already got some revenue. It's got some traction. I was single at the time. I said, and I took 70,000 in credit cards and emptied my 401k out. My perspective was at 25, I had a clean shot. I didn't have a wife and kids. And if I failed, I could go back to work and I would have given it one solid shot. The opportunity cost was low, right? And so it worked. So the earlier you do it, the easier it is. And if in this environment with, the way technology is, a lot of ideas that you can come up with for businesses don't require capital. They require what's between your ears. So there's a lot of intellectual capital required. There's not a lot of capital required, which is great. And so what that means is you don't need a lot of money to get these businesses off the ground. You can still have somebody be paying your rent and everything else. And then when the business has some traction and you can actually see some runway, at that point you can, make the switch and the cost is pretty low. Francis?
Yeah, but you have a really good question. So I could let you know what I was thinking in 1976 when I first came into Canada. So I was working for Bell Canada as a technician, like a repairman or an installer that you see. And so, I was getting restless. I was wondering what I should do with my life. And I said, okay, if I go into engineering, most likely I would just be kind of maybe average to above average. And if I go and become a doctor, most likely I'll be an average doctor, maybe above average. And the reason for going into engineering and let's say being a doctor is because of peer pressure. Your parents expect you to go into those lines. It has some prestige. And so for an Oriental, that's a perfect job. But I was not comfortable with that. So I was hunting around, looking around, what field should I go? What field that I have a competitive advantage just based on my lifestyle and the way my DNA is. So all my life, as you know, when you live in India, you're basically shopping. You're going to a bazaar. It's not like you go to a Walmart here where all the prices are marked. So you go and you haggle. You have to check, the prices, of any goods you buy, any vegetable you buy, and then you haggle. And then I read about Benjamin Graham in 1979. And then, I figured out that what he was saying is that if you can estimate the value a company, if it is 100, if you can buy it for 60 cents or 70% of that 100, then you got a bargain. And then I suddenly realized this is my field. This is what I've been doing all my life. I'm a notorious cheapskate, born like that. So that is the field why I picked. So that is, and so when I go to the stock market, I'm just looking for something that's marked down, and it has worked for me for 40 years. So the key thing is realize where, just the way you are, your DNA, the way you are as a person, the way you train yourself, and figure out, you have a competitive advantage, and then go to that field. But the second question is that if you decide to go to a certain field, you should have conviction. A lot of people say you cannot do it, you don't have a degree, and so on. But that is where confidence in yourself, confidence that if you work hard, you can break through. So that was the second thing I did. That was really important at that time.
And in case you guys haven't picked it up, Francis is not really Chinese. He's like a fake Chinese. He grew up in India, and actually, when he talks to me in Hindi, there are more cuss words in a sentence than I can utter over here. Not allowed to utter them, but I'm just saying that he's got an extensive vocabulary of salty Hindi. And he's a fake Chinese. Grew up in Allahabad in India.
That is quite correct. So I can speak the Indian language. I can read and write. Once upon a time, maybe not now.
Now he only remembers the bad words.
And I can tell you, if you shop a lot there in India, it's a perfect ground, perfect training ground for you to be a good value investor.
Team, go ahead.
Yeah, thank you for both of your time. I was wondering about your investment process when you are analyzing and making investment decision. Do you rely on the opinion and the analysis of other analysis, or do you only and solely rely on your own opinion to make your investment decisions?
Okay, Mohnish, maybe I'll go first. But basically, you have to rely on yourself. So early on in my career, because I was working in Bell Canada and I didn't have too much experience with companies, I kind of had that security blanket, kind of looking for financial bargains. Things are really, really cheap. But as you know, once you get into business, you understand the quality of business really matters. So now there's a more emphasis on what the company could be worth 5 years down the road, what the company could be worth 10 years down the road. So the analysis that you see on Wall Street is basically like short term, the earnings next quarter, earnings 6 months down the road, and those are kind of meaningless. So on our case, it's more valuation of company, what they're worth based on your valuation, and you go with that.
I have nothing to add.
Sounds like your buddy Munger.
Thank you.
Hi, this is Devlina. Thanks, sir. Thank you again, both of you, for coming and addressing us today. I've been following your website, the chai with the pabrai.com, and the free lunch portfolio that you have very carefully put together there. You also show us the Uber cannibals and the shameless cloning companies, and I know you have been speaking about cloning these well-known portfolios like yours. Now, for us amateur investors, to even think about cloning such high-profile portfolios, what key factors do you think we should keep in mind?
Well, I think the chai with Pabrai free lunch portfolios, those are designed to be kind of like set it and forget it, kind of like index investing, and so they're really. I mean, I think that stock picking. With all the discount brokers and now zero commissions and all of that, appears to be very easy and very simple. But in reality, figuring out what a business is worth and what its value is a few years into the future is extremely complicated. And for most humans, they are not going to have the time or the inclinations to be able to figure that out. So I think the best thing for most investors to do is to index. You can index with the S&P 500. That's a perfectly good way to go. You can also index with the free lunch portfolio, which is a mix of cannibals, spin-offs, and cloned ideas. And so we run our back tests, and we update that portfolio annually. And so I mean, that's a good way to go, but it's kind of like watching paint dry. If you're the kind of person who gets entertained watching paint dry, then the free lunch portfolio or indexing will work well for you. And if you need more action, then it's not going to work well for you.
Well, firstly, I wanted to thank Mr. Pabrai and Mr. Chou for the presentation tonight. It's very enlightening to me because my background is in engineering too, and halfway through my career, I decided to move to the finance sector. And that's part of the reason why I'm pursuing this graduate degree, so I can start investing on my own. So I guess my question is, when you're starting off, how did you increase your circle of competence and investing in financial instruments?
Well, I did it, as you know, I was kind of fortunate to start my investing career in that period of 1978 to 1981. So, as you know, the Dow had not gone anywhere from 1962 to 1981. It was 1,000 in 1962. In 1981, it was at 1,000, but during the recession of 1981-82, went down to 600. So the Dow was selling, below book value. It was at 6 times earnings on average, and a lot of them were at 6% dividend yield. So I came in at a really good time, and so I started with financial bargain. But slowly, you cannot do it within 6 months or a year or 2 years. And so you start with something really comfortable like financial bargains, and then you go into specializing into certain industries. But you have to give yourself time. You cannot rush it. You are going to make some mistakes. You're going to go to some kind of dead end decisions. Then you know it's a mistake, and you start again. And so go initially with something you're really secure with, and then increase your circle of competence. But you have to test yourself where you're most comfortable with. Like what is your engineering line? If it is in let's say airlines or engines, then you can start from there because you already have a background in that, in what you're studying.
Yeah, and I think what I would add is that it should not be an objective to broaden your circle of competence. I think what should be your objective is to make sure that, I always give the example of one of Charlie Munger's friends, John Arriaga, and John Arriaga is a billionaire. He lives in Palo Alto, and throughout his life, he's only invested in real estate within 1 mile of the Stanford campus. And so, his circle of competence is not real estate. It's not even California real estate. It's not even Northern California real estate. It's in a very, very small geography. But in that geography, I'm sure if I'm just walking with him on Palo Alto and I look at a random building, he could probably tell me everything about that building. He could probably tell me what the rents are, what it would sell for, everything about it. So he is operating in the epicenter of his circle of competence. And with him having such a narrow circle of competence, it did not prohibit him from becoming extremely wealthy. So one does not need to know everything about everything to do well. So in this business, being an inch wide and a mile deep is much better than being a mile wide and an inch deep. And so the key is, so first of all, there are areas and businesses today that you understand well. Focus on those. And the second is to have a curious mind and to read a lot. Buffett reads a lot of business biographies. And business biographies are just a really good way to learn different businesses and just how those founders or owners or managers thought about their business, right? And like recently, a few months ago, I read a book called Plain Talk. And Plain Talk is written by Ken Iverson, who was the CEO of Nucor. And Nucor did really well in mini mills. They ran circles around all the integrated steel companies and all of that in a tough business. And that book is a easy read and teaches you a lot about the mini mill business. And it also teaches you a lot about, great management and, business principles. So I think that being curious about businesses and just wanting to understand why things work a certain way. Like for example, I think Professor Sandoe brought up Carnival Cruise Lines, right? And I have never looked at Carnival Cruise Lines, but there are a few things that bother me about the business. And one of the things that bothers me about the business is that probably not an insignificant portion of their revenue comes from gambling. They've got captive casinos in all their boats, and once you get past 12 miles, the table's open. And the second is that all the cruise ship companies, from my vantage point, skirt the labor laws. So because they are not subject to the labor laws of any country, when you look at the crews on the cruise ships and what they are paid on a monthly basis and the hours they have to work, that would not pass muster with the US Department of Labor. It would not pass muster with most countries. And those individuals have to provide that service, because if they went back to their home countries, they wouldn't have even those opportunities. So the thing is that, to me, some of these aspects of this business bother me. Now, it may be rational or irrational to be bothered by these factors. But the way I look at it is that I don't need to spend any more time on the cruise ship business, because I see a couple of things that bother me. I could be completely off. It could be a straight 10-bagger very easily. My reservations may have no strong basis for, but the thing is that this is a business where there's no call strikes. So if Carnival ends up being a great investment and I don't make that investment, I have no tears I'm ever going to shed in the future about it, because I'm not interested in going there. But if a business is well understood by me, I look at it and I study it and I see that it can do well, and then I just graze on my navel and never pull the trigger on a trade, I absolutely would regret that later, because I should have pulled the trigger and I didn't. So I think that being a student of business, over time, the circle will expand, but one doesn't need a large circle to do well.
There's a lot of truth to what Mohnish is saying. I know the Davis family, they're worth $1 billion, and they just made it in insurance. There was another person I was talking to that only invests in small banks, and he made a fortune out of it. So you don't need to go like in many different fields. You can see it also in sports. If you're outstanding, let's say in baseball, you don't need to be outstanding in tennis or volleyball or basketball. And that's where you can make your fortune.
And it's the same with entrepreneurs. The entrepreneurs we like, admire, and respect so much, they have such narrow circle of competence, right? I mean, they just know everything about this much. And it's the only way they can succeed. They cannot succeed by being a jack of all trades. So the key to success, like Buffett and Gates say, focus, is narrow your scope, not broaden your scope. Just hone in very narrowly on a few things that you understand well, and that's more than enough.
So I've been writing a list. I won't give you guys the full list, but I'll start with this one. So, of the mistakes that you've made in investing, which one have you learned the most from over your careers?
Well, Robert, I liked my library till I saw your library. So thank you for making me feel great. Well, I'll go first. I think I had a couple of companies. Well, one went to zero during the financial crisis, Delta Financial, and another one was almost a zero. And because I run a concentrated portfolio, zeros hit you. And they're not that easy to recover from. But the thing is that those mistakes get seared in. And so after that, I developed the checklist and I studied why and what were the kinds of mistakes that most investors made. The number one reason why many investments don't work out is leverage. It's the number one reason why businesses fail. And it became obvious when I looked at the failures of other investors and my own. So it gave me a lot of pause on making investment in levered institutions. So I seriously cut back my interest in going into levered institutions, because I came to the conclusion that if you're a really good business, you know, Google or Amazon or Microsoft, you don't need leverage to make money. You would have very high returns on capital, and you don't need to increase. We didn't even get a good look at him, man. But
it's bedtime here.
the joys of COVID-19. So anyway, so I think that that for me, the number one thing that I learned was leverage, and to avoid it, and to minimize it, and to look at businesses which have the ability to make great returns without the use of leverage. Francis?
Yeah, but Mohnish, you make a really good point. Leverage is something that will really hurt you, especially, you know, you can see just as a prime example, like last 1 month, how the market has gone. But the second thing that I think can cause investors, and definitely me, a lot of grief is, let's say I go into a stock and I think it's worth 100, but it was a mistake in my valuation. So the stock goes down to 50, but instead of just admitting that I made a mistake in my valuation, I double up. It's just, you know, your emotions get in the way, your pride gets in the way. So the proper thing to do is to just admit it and, you know, either sell it or just stay put or try to get out as soon as possible. But the worst thing to do is just to go and double your bet, hoping to make back the money on that particular stock. You can always make back your money on something else, but does not have to be on that particular stock.
If I can ask a follow-up, because so you have a checklist, Mohnish. Can you share substantially what it is, like roughly?
Yeah, the checklist is proprietary. I haven't shared it, but I'll just tell you kind of how I went about building it. It isn't rocket science. So the premise was that if some great investor had an investment that ended up with a negative return, which is relatively easy to figure out from 13F filings. So I could, for example, take, you know, someone like Bill Ackman or David Einhorn or Warren Buffett and Charlie Munger, and I can go back and look at all the investments they made. And then I can also look at, you know, which ones made money and which one didn't, right? So I look at the ones where they lost money, and I ask myself the question that, would it have been obvious before the investment was made by these extremely good investors not to make the investment? Was there some data point available that would have told you that this is probably not going to work out? Like, let's say, for example, Buffett investing in US Air, right? I mean, you know, they were not the low-cost provider. Southwest Airlines came in, clobbered them, etc., and then, you know, it went south. So, you know, then you can say, okay, you know, are you the low-cost provider? You know, like that becomes a checklist item, right? Because it was the lack of them being a low-cost operator. And so I went through probably, and I had a couple of really good interns helping me when I was doing this. I went through probably, you know, hundreds of businesses, you know, maybe a dozen or 15, 20 investors, and all the failures. And the surprising thing was, in most cases, it was obvious before the investment was made that there was a relatively easy weak link to figure out. In my case, I used to look at these levered institutions, and yeah, it looks great on the upside, but then on the downside, you know, your equity is levered 20-1, and you're just gone. You know, you can't even take a gentle breeze, forget a storm. So the thing is that the checklist basically got built from post-mortems on a number of good investors. And then what I did is I sorted the checklist by category. The biggest area was leverage, was the one that caused the most issue, most hard one. The number 2 area was related to moats, either misunderstanding or not figuring out the nuances of the moat, right? There were other things too, like, let's say some company failed because of labor relations, that was pretty small, or environmental factors, pretty small. But these were the big ones, the leverage, quality of management, and moat, probably the three biggest ones, right? And, why do you need a checklist to tell you that? It should be obvious to us before we even look at a checklist. I mean, yeah. And so one of the things that, it's never too late to grow up. When the financial crisis was going on in 08, 09, I was finding all these bargains, and I was just interested. I set a threshold that I want at least a 5x. If I'm going to make an investment, it has to be a 5x. I wasn't concerned whether they were great businesses or not. All I wanted was the pie is discounted enough that I can get a 5-bagger. And that did happen, in the sense that the investments I made, eventually, most of them became 5x's or more. This time around, I said, I'm not interested in discounted pies. I'm interested in growing pies. Okay, so Mohnish has grown up a little bit in 11 years. Okay, so I said, number one, I want growing pies. I don't want cheap discounted pies that are not going to grow. And number two, 5x is for losers. Okay, I'm going for 10x. Okay, so I said, I want growing pies, and I want that pie to be a 10x in 5 years. And once you set that benchmark, life becomes really simple, because most things don't make that cut. And then you can plan accordingly. And in 2019, I made 3 investments, and even in the age of Corona, I'm really happy. I'm really happy with 2 of them. The third one, I think we'll still do okay on, even with Corona and all that. In 2020, I made 1 investment I'm really happy with. Nice straight 10x in 5 years, nice moat. And the thing is, so investments fall to me, and this is my learning in 11 years, Mohnish has finally figured out that investments fall into 3 categories. Okay. 1, discounted pies. I'm talking about value investments, right? We're not talking about, these moonshot things trading at 100 times earnings. But one is the pie is heavily discounted. It's not going to grow much, or it may not grow at all, but you're getting a discounted pie. Okay. The second is obviously great businesses, right? Growing pies, but the whole planet knows they're growing. Google, Amazon, Microsoft, Salesforce, etc. The problem with the growing pies, which Francis and I am Mohnish Pabrai, and I'm an alcoholic, and I'll say it for Francis, I'm Francis Chou, and I'm an alcoholic. The problem Francis and I have is we are so cheap that we can never invest in those businesses. We know that those businesses are really good. And we know 10 years from now, when we look at them, we'll say, you dummy, of course it was a great business. Why didn't you buy it? Well, we cannot buy those. Okay. We cannot buy, the day I see Microsoft in Francis's portfolio, I'll jump out of my chair. Okay. So I'm not going to see Salesforce in his portfolio. I'm not going to see Microsoft in his portfolio. And I'm definitely not going to see Amazon in his portfolio. You can just take that to the bank. Ain't happening, even though they're phenomenal businesses. So there's a third category. The third category is where we can actually make some hay. And those are the hidden moats. So we cannot go after the obvious moats because the whole planet knows about them. The cat's out of the bag, we're hosed. It's the hidden moats where the action is. And 11 years ago, I didn't understand this. I just focused on discounted pies. Now I said, I don't want any discounted pies. I've had enough pie to last me a lifetime, which is discounted pies. I want growing pies, and I want deep moats, but I want those moats where no human can understand that there's a moat, or very few humans can understand it. And so we can go play there. And maybe sometime if we do another session, if Professor Sandoe has us back, we'll go deep into the hidden moats. Francis?
Yeah,
Francis,
let me put into numbers what Mohnish is saying between we're investing in companies that has no growth versus companies that has growth. So you can just take a simple number. Let's say a company growing, let's say 15% a year. That 15% a year, that company is doubling every 5 years. So in 10 years, it has gone up 4 times. So think about it like this: you buy a company, let's say worth 100 in your estimation, you pay 50 cents. 50% of that. So you're buying it at 50 cents on a dollar. And you buy another company, right, that is growing at 15% a year. So your $100, even if you pay, let's say 100 cents on a dollar, let's say you pay 100, but in 10 years, that is worth 400. But if you go into a company that is not growing, in 10 years, it is still stuck at $100. So which is a better buy? 100 cents on a dollar or 50 cents on a dollar that has no growth? So that this is kind of a thing that we as value investors will always face. We always want something cheap today, but we don't put enough emphasis on what it will be worth, let's say 10 years down the road. And we learn from experience, just like Buffett had learned from experience, that it makes more sense to go with companies that are growing rather than with companies that are not growing, even if you get a big bargain.
Hey, Francis, have you bought Salesforce yet?
No, I bought Apple.
You bought Apple?
Yeah, to make
oh my
you happy.
God. Oh
yeah,
my God. He paid a double-digit PE.
Yeah, no, I bought it at $160.
Oh, that's great, Francis. Why didn't you call me?
Last year when it went down.
Next time, Francis, call me collect, okay?
Okay.
Yeah, call me collect.
Okay.
I know that from Toronto, it's an expensive call, so call collect.
Okay. We do have that in the portfolio. And the stuff you bought for, for Stonetrust, you bought Google at 500. I still kept it and went with it.
That's right. I left him Google. It's good that he kept it.
No, it was growing rapidly, so it made sense to do it. Most probably, I would have sold it 20 years ago, but as you know, with experience, you learn a little bit.
So see, there's even some hope for Francis and me. We're still learning.
And so the key part is you have to reassess how you have done, where you have been successful, and a lot of times your failures is not the mistakes you made, let's say by buying the wrong stock. A lot of mistakes are made by not buying the stock that you should have bought, which is much harder to analyze. So second area that I would want students to be careful of is sometimes you go into crappy companies where you can get seduced by a financial bargain, let's say a financial deal. For example, like Buffett knew airlines were really bad. He bought US Air, but he got seduced by a big fat dividend that he got. So he knew, based on his experience, it's a lousy industry, lousy company. I shouldn't be in it. So he just got a little bit, 2-3 points more in dividends, and he got hooked and he got seduced by it. So in essence, what I'm trying to say is that look at the company itself, not at the deal that gets you into it. Now, I had my fair share of that, by the way.
Thank you both so much.
Okay, Alex, why don't you go ahead?
Hey, thank you guys both for being here, Mr. Chou and Mr. Pabrai. Mr. Pabrai, I have my whole afternoon out, so nothing to do. So if you want to go into those hidden moats, I'll be here as long as you need me to be. I was going to ask you, though, in all honesty, about the Kelly formula in terms of how much to allocate to your portfolio. I mean, it's tough to, like, even if you're 100% sure to bet, that much. Like, how much do you take the Kelly formula into your real life experience, and or do you at all, or is it just kind of an interesting thing to think about, or for both of you guys? And is that something? How do you take that and practically use it?
Yeah. So the Kelly formula actually is a mistake in my book, and if I were to do a second edition, I would basically say that I would take it out completely. So the Kelly formula really does not apply to investing as we do it, and the reason is that it works well if you get to place a zillion sequential bets. So for example, if the odds of heads was 51% and the odds of tails was 49%, and you got to do this 2,000 times, then you can come up with a formula for what is the optimal bet sizing based on your bankroll and those odds, okay? But in investing, what happens is we get a one-off opportunity, right? We'll get one bet where heads is 70%, tails is 30%, or heads is 90%, tails is 10%, but we don't get to do that repeatedly. So the formula actually doesn't apply to the format that we find ourselves in. So I would just ignore Kelly completely.
Thank you. Okay. So how would you go about allocating? I mean, if you have a bet that you think is 100%, you know, you're like, oh, I can't wait to invest in this, and you have 10,000, 100,000, a million.
Well, I mean, I think an error rate is guaranteed for every one of us. Anything you buy can go to zero. So probably not a good idea to be single stock, no matter what your conviction levels are. But I also feel that having 20 stocks is also not bright. It's very hard to really understand 20 businesses in 20 different industries really well. Very few of us can do that. And to find all of them being heavily mispriced. So in my portfolio, I've always targeted kind of a 10% upper limit. That's in the funds I manage. Personally, I've been willing, I had set up UGMA accounts for my daughters when they were very young. You know, we'd put in $15,000 a year, my wife and I, into those accounts. And there was such a long runway on those, some 3-year-old, I'm putting 30,000 in. It's a very long runway, right? And so those accounts, I was willing to go down to 2 or 3 investments, the highest conviction ideas, because even if it didn't work, I mean, there was a lot of leeway to come back and do things, but I wanted to make sure that, and actually it's ended up being a significant sum of money for them. At this point, it's worked out very well. And so I'd say that probably not worth looking at more than a 1/10 allocation unless you just, bouncing off the walls of conviction, can't see a downside, etc. Francis?
Yeah, I know from experience the Kelly formula is extremely dangerous, and part of it is something called self-assessment. So you may go into a situation and say, on this particular stock, I have, let's say, 90% confident it will do well. But that is your assessment. But think about it like this. If that same stock, the same company that you have 90% confident, and I give it to someone who's also equally confident, let's say someone who knows that equally well, let's say Buffett, he may say, on that stock, I only have a 10% confidence. So there's a reality check between someone who's been in the field for a long time and knows the company, and based on this analysis, the success may be just 10 or 20%, but based on your analysis could be 100% or 90%. So you just have to be careful with that, where your level of confidence is. So when I was younger, sometimes, I would go into certain situations and I think I would, 90% confident. I'm so confident I would put so much money into it. But when I look back on it now, that 90% confidence was not justified by my experience and the knowledge of that company and that industry. But at the moment of making it, yes, you feel like so super confident. So you have to sometimes be aware of that human element there. Now, Munger can say it, Buffett can say it, but they're saying it with so much more, not so much more experience and knowledge in that given field, and therefore they can go into 3 or 4 stocks. That may not be enough, may not make sense for a lot of us. So so your confidence should be, equal to how knowledgeable, how solid, how good you are in that given field.
Both very much. Thank you.
Mo, why don't you go ahead?
Thank you, gentlemen. Mr. Pabrai, Mr. Chou, thank you so much for coming. Great presentation. I have a 2-part question. Once upon a time, there existed a company called Enron. A great organization by all accounts. Looking at the financial statements, the company looked great. Investment community, everybody was saying it was a great company, one of the 7 greatest companies in America. And we all know what happened. So what would you have invested in the company, first of all? And if not, why? Before they went down, before everybody knew what really transpired. And the second part of my question was, how long did it take for your portfolios to bounce back after the 2007, 2008 financial debacle?
Yeah, regarding Enron, I never invested in the business, and I never even, I think, even seriously looked at it. I think a lot of stuff in energy is outside my circle of competence. And, I'll give you an example. So I like to understand how a business makes money. I think that's I'll give you an example of Amazon. One of the things that I've never understood about Amazon, I mean, I think it's a phenomenal business and it's done so well, is, they've got Amazon Prime, and we all are Amazon Prime members. And I know for a fact, with all the gazillion things I order from Amazon, that they lose money on shipping. There's no way they can ship me all the stuff I'm buying for $100 a year or whatever they're charging right now. And so when I look at Amazon's retail operations, in my head, I cannot figure out how it makes money, right? I mean, I can understand that when they have the marketplace, third-party sellers, and they provide all the services or whatever, they're charging fees to the seller, I can understand that part. But when Amazon's selling stuff themselves, they have the warehouses, they're bringing stuff to the warehouses, they're shipping it to me in 2 days, all this stuff. I mean, I send a FedEx letter from Irvine to San Francisco, it's $25-$30, just this little letter that I sent. So the way I look at it is that it somehow works for them. It must work for them because clearly now Amazon Web Services, I understand it clearly, right? Google's different businesses, I can understand those. Apple, I can understand. So it doesn't, I'm not in any way implying there's any issues with Amazon's financials or anything like that. But what I am saying is, I don't understand it. I don't need to go there. I don't need to understand it. There's 30,000 other stocks to look at. Francis?
You have a good answer there, that you don't need to go into Enron. But one of the big problems with Enron was a lot of their revenues were booked on derivative accounting, which is extremely dangerous. And so you come to a point where revenues were not like real, but they were kind of derived and estimated. And when you have something that is estimated or derived through derivatives, you just have to be extremely careful. So they were not like real revenues, neither real earnings. You can always play with numbers. GE got into some kind of trouble too, like last 2 or 3 years. They were making deals going into 60 years and then trying to get revenues into it because they wanted to show some growth. And so be very careful with accounting when you're looking at companies.
Thank you.
What was your second question? I missed it.
Oh, the second part of the question was, thanks for asking, by the way, was how long did it take your portfolio to bounce back after the 2007, 2008 financial debacle?
Normally, you should bounce back within 2 years, roughly. There's a big bounce in 2009 and 2009, 2010, and it comes back super fast. In almost every downturn, like say 1973, 74, or 81, 82, the bounce back is fairly quick.
Yeah, and I think Mo, in my case, I have a deal with my investors where, I don't charge management fees. I just get paid 1/4, about 6%, but I have to hit high water marks. So we were down 65 to 70% in the financial crisis, a lot more than the indices. So for me to earn a fee, first I had to get back to 100 cents, and like say from 35 cents to 100 cents. And then I had to make up the 6% a year from the middle of 2007, when the previous high water mark was. And so I came back to the 100 cents relatively quickly, because I think in the first year, in 2009, we were up like 110%. For example, 2010 also we were up a lot. So to Francis's point, yeah, in 2 or 3 years you're back. But it took me from 2007 to 2017 before I earned a fee on one of my funds. It took 10 years, but I was able to live very comfortably on fresh air and water for 10 years. As you can see, it had no impact on my health. And the thing is that the fees are, in this business, the leverage is so extreme. I think in 2007, my fees were like 30 million or something. And in 2017, they were like more than 50 or 60 million. And life is great. If every 10 years I get 50 million, I can manage, I can make it work.
Thank you very much.
All right, I want to be respectful of your time, gentlemen. We have 3 questions that remain, but I want to be respectful. And so if either of you have to drop off or want to drop off.
Yeah, so actually Francis and I have no issues. Francis is here till midnight, no problem.
Yeah, I'm fine with that.
Yeah, he doesn't go to bed. He's bored, so he's happy to be here. So whenever you get bored of us, we'll leave.
I take it away. Any of the 3 of you can
I jump in? Can I jump in? Can you hear me?
Yes.
Yeah, I can hear
great.
you.
Thank you. Yeah, first of all, I'd like to thank both Francis and Mohnish for sharing your knowledge and experience. It's really an inspiration to me, and because both of you were like immigrants, but ended up with a very successful investment career. And I also particularly like to thank Mohnish for your book, The Sandoe Investors. I read it completely. I think it's a book that's worth repeating. And also it resonates with me, that book, because you have some experience that really kind of match my experience. You mentioned that you work for Tel Labs. I also work for Tel Labs.
All right.
And I wish I had met you there, so that, as you said, right, you better start early. And so if I started early there with you, then you think about it, the compounding in knowledge, right? So that's really great. I think this is really serendipitous. And so I think one question I really have is about the Kelly formula, because it seems to be a repeating theme in that book. But of course, as you guys just mentioned earlier, it seemed that this is the thing that is out of date. I think Francis said that probably the reason it is not so good is because the estimate of the confidence for the outcomes. And actually, when I was reading the scenarios that you wrote, I had a similar question too, because I think, how do you estimate? And so I'm just wondering, given that we know that's a limitation, and is there any way for us to kind of get a more accurate estimate of the probability of the different outcomes? So that's kind of my question.
Francis?
Oh, you have a difficult one. As estimation of valuation is sometimes, just go a range. You can say it's worth somewhere between 80 to 120. And you say, okay, on average it's 100. So it's not a precise number. And you want a lot of safety.
So Francis, he's asking for the probability. Like, let's say stock's at 50. What's the probability it's worth 100?
Yeah, upside or downside, the probability of upside or multiple outcomes, right? Something like that.
Oh, okay. And so basically, the old-fashioned way is we just took retained earnings and how much it's growing, something like that.
Retained earning and how much it's growing.
Yeah. So whatever they make, it's retained into the business, right? So indirectly, you get an idea of the growth rate.
Well,
let's say if your ROE is 20%. And if the company has done as well as it has done in the past, most probably it will be growing at 20% a year, as long as they can deploy that 20% earnings into the same kind of growth as they have in the original business.
So
That's
how I would,
a rough way of doing it. The
I,
other way is much more harder. You can say, I'm going into technology, I'm going to something new like internet, and it's exploding at 30% a year. But that is far more harder to do. Like I missed out on a lot of great buys last 10 years. I never expected, for example, let's say Google to grow at like 25% a year, in spite of being, 10 years ago was still a really big company. Same thing like Amazon has been growing at a really fast rate in terms of revenues, not in terms of profits. And same thing with Netflix and few other companies. 30% a year means revenues are doubling every 2 years, 2.5 years. And in 10 years means it's gone up, like 7, 8 times. It's really hard to imagine something that could grow that rapidly for a long time. You can think about it like for a small company, but not for some giants. At some point, the numbers will come into play. Like there will be diminishing returns.
so how I would say that it depends on the nature of the business. So for example, let's say I'm looking at a funeral services operator. Okay. I don't know who will die in Cedar Rapids, Iowa next year, but I know how many will die in Cedar Rapids, Iowa next year. Okay. And so a business like the funeral services business, the number of people dying in a given year is somewhat predictable. Okay. If I look at a casino in Vegas, for example, let's say the Wynn Las Vegas or the Wynn Boston, for example, Encore Boston, right? What are their revenues in 2021? Well, the certainty on that is much different than the certainty on the funeral services business or, Carnival's business in the future, Mm-hmm. So each business has a different certainty of likelihood of those revenues and profits coming in, and it varies a lot. And the other thing to keep in mind is capitalism is very brutal. Everyone's out to take everyone out. Dog eat dog. It's a very competitive landscape. Creative disruption, it's what makes our economy work. And so the only defense we have against all of these factors is to have a number of bets. So we cannot have, like Francis said, a high degree of conviction on our own. I could have never, no one could have said that Vegas would go to 0 customers for several weeks in a row. Okay. Who would have ever imagined that? Right? Who would ever imagine that, like the other day, there's an airplane that flew with 1 passenger. Okay. The things we are seeing happening in the world would not have shown up in any projection you would have made. And so the only defense you have against that, because, my friend Guy Spear, I was talking to him earlier today, he says he's come to the conclusion that 100-year events happen every 10 years and 50-year events happen every 7 years. So his perspective is there's no such thing as 100-year events happening every 100 years. And he thought once he rode out the financial crisis, 08, 09, he could safely go to his grave and he'd never see another blimp again. Okay. And now he's resigned to the fact that every 5 or 10 years, he's going to see some earth-shattering event come through, which he can't imagine. So I think the best thing that we can do is make sure we make investments where knowingly we know the odds of us making money are really high and the odds of us losing money are really, really low. That's even more important than the making money part. And make a few diversified bets. Don't buy 3 REITs and say you're diversified. Don't buy 3 casinos and say you're diversified, right? So make a few diversified bets within your circle of competence, hopefully 8 or 10 bets. Don't sweat, is it 90% or 80% or 70%? Because we don't know. We just aren't that good as humans to see in the future.
That's great. And another quick question. What will be your maximum bets, like optimal number of bets you would like to make?
I don't put more than 10% of the fund into anything.
How many bets? How many?
Ideally, it will be 10 bets.
Okay, gotcha. Okay, looks sense. Like 10 times 10, 100%. That's great.
And Francis, what about you, Francis?
I'm between 10 and 15. And sometimes they're going to make mistakes in that 10 and 15 stocks, but sometimes you can get whacked, from left field. I know recently, we were in airlines, and you can see what happened to airlines. And most probably the intrinsic value, what has happened recently, most probably you can take 20 to 30% off its intrinsic value. So if I thought it was worth 100 on some of these airlines, well, right now I think it's between 70 and 80. It has not destroyed that industry, but definitely has impacted the intrinsic value. But those are the things you have to take into consideration. It can come from left field.
Yeah, and
not just your mistakes.
The government doesn't care about the situation with the equity holder of airlines. They just care about airlines flying. So the airlines are going to be around. What happens to the equity investor is a different question.
Yeah, you can see the same thing happening with small banks. Zero interest rate, and they cannot make any money on it. They don't have any other avenue. So small banks and rural cities are really suffering. So that there are the measures that the government have taken is there are a lot of pain there. A lot of people don't see it.
Right.
And the business people and investors have taken a big hit, especially those who have borrowed money and have been on margin.
Great. Thank you. Yeah, thank you both for perfect answers. Thank you so much.
Hi, my name is Shimon. Thank you so much, both of you, for joining us, and thank you so much for sharing your knowledge with us. Really appreciate it, and really appreciate reading your book as well, the Sandoe Investor. I know that Warren Buffett invests in businesses where he can go and see how the business is doing. Aside from the trusted business partners that you are, how important is it for each of you to see what you're investing in, to go and see how the business is doing, go touch, feel, etc.?
I'll go first, Francis. I used to have a perspective, probably coming from Ben Graham, that if you went and met the CEOs of the business, etc., their number one skill they all have in common is they're great sales guys. That's how they got that job. So generally speaking, your judgment would get swayed quite a bit negatively if you met those super salesmen. But on the other hand, if you read Phil Fisher's book, Common Stocks and Uncommon Profits, which is a terrific read, Scuttlebutt is really good, which is, poke around in different areas of the business to try to understand it. That's really good. I am probably guilty of doing very little scuttlebutt or things in terms of kicking the tires for most of my career as an investor. I used to just be an armchair investor, if you will. And when I started investing internationally, I had to eliminate fraud risk. So I had to, get on an airplane and go kick the tires and so on. And that actually I found to be very invigorating. It was really good. And I think my perspective was flawed. So I think that the more you can do Phil Fisher type scuttlebutt, and the better you can understand the business. And you can get Phil Fisher is like doing a 360, talk to ex-employees, talk to customers, talk to vendors, just get a full view of what's going on in the business. It's going to help you a lot. Francis?
Yeah, Mohnish, what you're saying makes a lot of sense. Like I don't mind meeting the CEOs, but what I try to do is to know the company first. So I would go through, let's say, last 10 years of their numbers, look at the capital allocation decisions, how it has gone, and how they have made money, and where they are allocating all those retained earnings. So after I know all that, after I have a good idea, I have a firm, made some kind of sense to myself. I know how good the company is, how good the management is. Then I'm quite willing to meet them. But sometimes, as talking about earlier, sometimes I just take it literally. Mohnish, as told me when I was buying Stonetrust, listen to me. When you buy a company, you need to know the man. So I'm Mohnish Pabrai. You don't need to do any due diligence. And I took his word for it. So I didn't even do any. I didn't even see the company until, I didn't go to Baton Rouge until 4 months after I bought the company.
It looks like it worked out well. So
Yeah, it worked out really well. Yes. In this case, yes.
well, thank you very much.
Both of you for staying late with us tonight. And I know your time is valuable, so I'll keep my answer short. From your practice experience, even though you already find a company within your competence circle, and when you do the evaluation for the company, what are the signals that can trigger you to sense the dangers, the risks, or you make you to be more cautious? Besides the legal issues, besides the tons of debt, besides the longer, accounts receivable that you cannot collect?
That's a great question, Ren. So I think one of the best pieces of advice I got from Charlie Munger is he told me that it's very important to have somebody to talk to about your investments. So he told me, I've always had somebody to talk to about my investments. So I said, oh, you mean like Warren Buffett? So he said, well, it wasn't always Buffett, but it's very important to have somebody you can bounce things off of. Because the thing is that when we look at a business, we are biased based on all our past learning and experience. And we may not see something that is obvious to someone else. So if you can get different perspectives on the business from different people, it's going to help you understand the business better. So many times we are not going to really be able to get to the promised land just by looking at the data. I think the thing is that, it's what Munger calls the lattice work of mental models. The number of things that affect the future of a business is so many things. It could be the CEO, could be the team, could be the environment, could be, competitive forces. There's a zillion things going on that affect the future of the business. And so the better you can get at understanding that, the better you're going to be as an investor. And I think bouncing things off others can be really, really powerful. And Buffett and Munger complain, they actually said it many times, that the two of them think so similarly that they are very concerned that if it gets past one filter, it'll go through the second filter too. So to the extent that you can have someone who is a person you can trust and has different life experiences than you and looks at things differently, that's a very big advantage. Francis?
Yeah, Mohnish, you have a really good point. I know when I was working in Fairfax, and so we would come up, let's say we really like this stock, blah, 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 and all that stuff. And so we would appoint someone really senior among ourselves to look at all the negatives and tell us what's wrong with the investments. So we didn't take a junior guy because the junior guy will always, as you know, sometimes an organization will always defer to someone that is senior and that may not want to make a noise. But we would always get someone really senior to go and check, if there's any fallacy, the way we are thinking and the way we're executing it, or something that we missed. But the Charlie Munger and Buffett relationship is also special because Munger is not afraid to tell Buffett that you're an idiot. So that worked really well too. So you need someone like Munger who is frank, open, and just tell Buffett that you're making a mistake. A lot of people in the position of Munger most probably will defer to what Buffett is doing. Like in my case, when I run my mutual fund, you need sometimes like checks and balances because I run it by myself. So in my case, I just punish myself. Like last year in 2019, I did badly for my bond fund. So I gave back $1.5 billion in fees. As I rebated 4 years of fees as a punishment. So that sharpens you up really quick.
But generally speaking, that relationship shouldn't be a master-slave relationship. It should be a peer relationship. So generally speaking, I think in an investment shop, it shouldn't be someone reporting to you. I've had a lot of great conversations with Guy Spear. I've had a number of great conversations with other people who don't work for me, but that gives them the freedom to be very objective.
That's a great advice. Thank you so much.
Gentlemen, thank you very, very much for spending the time you have with us. These have been wonderful insights. I am not going to ask about anything you're buying now, but I am curious about what your view of the world is at this point in terms of where earnings could go, the macro picture in general, which I know is different than how you allocate investments, but that would be very helpful just to get your view of what's going on and how unique it is and what your expectations are.
Okay, I can go first. As you know, my view is a little bit philosophical, a little bit, political. We live like in a free enterprise country, right? It's extremely resilient, and it's a type of a system where most likely, you can have events like the Great Depression, the Great Recession of 2008. You can have, Second World War, the First World War. In time, every generation or every 10 years, things will be better than what has been in the past. So if you ask me, I would say, even 5 years from now, 10 years from now, we'll have, a higher GDP, a higher standard of living, and the stock market should be much, much, much higher, just because of the type of systems we have, type of government we have here.
Yeah, what I would say is that, man is a very clever animal. And even as we observe, look at the US, you can say fumbled, stumbled response to COVID. Actually, this is a super athlete. And the super athlete got on its knees and he's standing up very quickly. So as I see things, like the other day I was listening to, I think a PBS podcast where they had the CEO of Ventec, making the ventilators. And Ventec makes 150 ventilators a month. And, obviously they got all kinds of calls and they said, we can max it to 1,000 a month with all our infrastructure. That's the max we can do. So GM got paired up with them, and about 4 days later, the guy is saying we will produce 20,000 a month. So they went from 150 to 20,000 because the guy said that GM is not an auto parts company. It's this incredible global supply chain manager. GM threw 800 of its people, its supply chain engine onto Ventec, went after the entire supplier base, which makes auto parts. And those guys are taking pistons that went into cars and miniaturizing them and making pistons that go into ventilators. I mean, I think the human response is a superhuman response. And we are seeing that response on vaccines. We are seeing that response on antivirals, on every single facet of what's going on. So I would be very surprised if we are not in a very different situation in maybe 4 to 8 weeks. I think it'd be a very different ball game. Almost every day we are hearing about breakthroughs in testing, breakthroughs in different aspects. So it would really surprise me if 8 weeks from now, this athlete is not sprinting. And the second thing is that it's a very intense shock to the system. Businesses by their very nature are extremely fragile. Most businesses cannot survive if you take away their revenue for 2 or 3 months. A lot of small businesses, small restaurants out of business, a lot of small businesses with all the help the government is giving will not make it. A lot of large businesses will have equities impaired in, like airlines, for example. I think they'll make it, but what those equity returns end up being is a different question. But I would say that when you fast forward a few years, we would not even be able to look back and say, oh, we can see the scars of what happened. We cannot see the scars of what happened in the financial crisis very easily today. And those are some pretty deep scars. And we learned a lot of lessons. In fact, the banks are in such good shape because of all the lessons we learned then. So I wouldn't ever count America out. I wouldn't count the world out. I wouldn't count humans out. And I think we will prevail. And I think we will not be having sessions like this too far into the future. So thank you.
This is great, and thank you for being willing to stick around and answer questions, enthusiastically respond, and also responding from your training, but also responding from your personality and your philosophy. I think this has exceeded expectations.
All right, great. It was a fun afternoon.
Thank you, Professor.
Okay. Well, thank you so much, and take care. Have a good